After a challenging 10 days, it's nice to see a positive start to the week with momentum from last Friday persisting into today to get the S&P 500 and the Nasdaq above key overhead resistance levels. To me, the close we saw today suggests that we are going to test all-time highs on both indices within the next few days. We also have tailwinds from the US and China tensions easing, earnings season starting off strong with now 86% of companies beating on EPS and 84% beating on revenue. And lastly, we have market technicals showing a strong rebound from oversold conditions that we got back on October 10th that now suggest continued upward momentum. Leading the charge is, of course, semiconductors, tech, and even healthcare, which really surprised me. Crypto has, however, turned into the laggard, which is still feeling the sentiment drag from that crash a little over a week ago, and of course, the timing of the end of the 4-year cycle. So let's dive right into it to discuss the macro and key charts for stocks, commodities, and crypto. Let's go. This isn't financial advice. Past results are not indicative of future performance. Do your own research. Welcome back to the Trading Apologist. My name is Tom, and I hope you all had a wonderful weekend and also saw some recovery in your portfolios over Friday and today. Before we dive in, likes, comments, and subscribes are very much appreciated. They really do help the channel out in these early days, and they mean a lot to me personally. And honestly, I've really enjoyed reading through some of those kind comments and bits of feedback. So thank you very much for that. As we start the week, I want us to take a step back today and take a balanced look at both the bullish and bearish forces that are shaping markets right now, because like with most things in life, the truth is usually sitting somewhere in the middle. And with us coming to the end of the traditional timing cycle for a crypto 4-year cycle, and there being a bit of uncertainty in broader markets with some definite cracks in the background, but some bullish signs with where we sit in the rate cutting cycle. We have that Zweig breadth thrust from the spring. Anyway, I just want us to look at both sides so we can sharpen up our thesis, because as I've said in a few videos, our job really this fall is to figure out if we are going to continue on an upward trajectory over the next 12, 18, 24 months, or if we are entering more of a corrective cycle. Now, before we get into all that, I do want to mention a few things on earnings this week. We got past all the banking info from last week, and it's a bit of a lighter week, but we are starting with tech. So Netflix kicks things off tomorrow on Tuesday, followed by Tesla on Wednesday, and Intel on Thursday. We also have Deckers Brands reporting on Thursday for any of you that are tracking along with that trade that we have made here. Now, on the macro side, we are finally getting some fresh government data this week. On Friday, we're going to get the CPI print to land during the middle of the government shutdown. They're making an exception for this, and this is going to be the only piece of data that will be released. Now, it marks the first time that CPI has been released on a Friday since 2018, and Friday is generally not the best day for that data to roll out, but we will take it. And it also comes just 5 days before the October 29th Fed meeting, where JP and company are going to debate whether to continue their rate cutting cycle. Now, adding on a little bit more fuel on the bullish camp, Trump over the weekend hinted at easing his stance on China, saying that he's open to lifting tariffs if Beijing reciprocates. So that headline alone, or that event, could add some short-term tailwinds to that risk sentiment. It's one of those things that caused a major overhang, but with the snap of a finger, it could all be lifted. If we're looking at the remaining items, at least in the near term on the bullish side, the VIX briefly spiked above 28 on Friday, while the S&P 500 stayed within 3% of all-time highs, something that we've only seen a couple times before, and that was in 1998 and again in 2020 to 2021. Now, historically, this kind of volatility with the VIX spiking and then dropping back down, that signal tends to appear during late-stage melt-up rallies, but it's not something that usually fires right before a major correction. So put that on the bullish side. We're also seeing buyers step back in aggressively. Investors added nearly $3.9 billion into US equities last week. Single stock inflows hit $4.1 billion. That's the fifth largest since 2008, and the biggest ever week when the S&P 500 was actually down 1%. Institutions also led with $4.4 billion of inflows from them, while retail investors added another $1.1 billion, showing that dip buying is alive and well. Hedge funds, meanwhile, they remain net sellers, and that divergence could continue fueling upside pressure if they are forced to chase later on in this rally. They've been selling for 5 weeks straight now, and hedge funds, ironically, don't have the best track record when it comes to performance. Now, statistically, the buy the dip approach is having its best run in 30 years, second only to the 2020 to 2021 rally. And investors know what's ahead. In just 2 weeks, we entered the historically strong 6-month stretch of November to April for equities, which is the strongest 6 months of the year for equity performance. Add to that the bond market is now pricing in almost 100% odds of rate cuts at both the October and December Fed meeting, which would bring the federal funds rate down towards 3.5 to 3.75%. And the bullish case is pretty easy to make based on all that alone. But let's look at the bearish side of things as well. There are some cracks that we definitely need to note that are worth watching. Now, the government shutdown has delayed jobs reports, one of the Fed's most important data points that they look to. But even before that, economists expect significant downside revisions, as many as 950,000 fewer jobs over the past year, according to Goldman Sachs. Now, that would be the largest 12-month adjustment in 15 years, and it's coming just as the Fed weighs its next steps on rates. So as it comes to rates, even though the bonds market is putting the odds in the favor of yes, we know that the jobs market is not looking good. Then there is the growing debt picture in the US, which we have been discussing for quite some time, but US public debt just surged past $37.9 trillion, up more than $400 billion in just the past month. If we want to have some fun with numbers, that equates to roughly $25 billion a day. Since the debt ceiling was raised in July, total debt has jumped by $1.7 trillion, putting us on track to hit that round $40 trillion number by early 2026. Congratulations, America. We have done it. We are number one again. Maybe not in education or healthcare, but number one in debt. Woo! And finally, beneath the surface, one thing I think all of us should be paying attention to is the rise of CLOs, or collateralized loan obligations. You might have never heard of this, but let's dive in because it's worth paying attention. Now, the CLO market bundles risky corporate loans and then offers them to B-rate borrowers sliced into these safe risk layers. To me, this is showing eerie echoes of that pre-2008 subprime mortgage regime because it's complex, yield-chasing, and structurally very opaque. About 80% of these loans are now covenant-light, meaning that there is almost no oversight of risky borrowers. And CLOs, they keep weak companies alive and they inflate bad credit. This works for the near term until refinancing walls hit and or liquidity dries up. So this is a slow burn in the background, but it's accelerating and building, and it's worth keeping on the radar, particularly if we see liquidity begin to tighten. Now, if I had to distill all of this down, I would frame it as a mix of near-term optimism and long-term caution. A market that wants to climb higher, and we're clearly seeing that, but still has several very important macro tripwires that we really need to watch out for. So if things stay on track, it does really seem like the timing could work out well for the thesis that we have discussed about traditional post-rate cut cycles that run for the next 18 or 24 months before we see a bigger correction. So let's see how that continues to unfold over the coming weeks and months. I'll of course keep you guys updated, but for now, let's dive right into the charts. Okay, starting on the S&P 500, and you'll notice that I'm on a different chart in a different time frame. I'm on the ES1 E-mini futures chart. So we can see all the overnight price action in the blue areas here, and I'm also on the 1 hour time frame, have been since that crash on the 10th, to really give us a sense of what's happening with the recovery and how the market is responding as each of these events unfold. And the great thing today, after our positive rally on Friday, was that we were able to push through this key resistance line, which corresponds to our previous all-time highs on the 22nd of September, and then that range that we broke out to. So this is an area we rejected from once in the middle of last week. Now we have made fresh recovery highs, and we are very close to printing new all-time highs for the S&P 500. And if we are looking to the Nasdaq on a similar time frame, you can see how we broke above that level on the Nasdaq today as well, and actually closed slightly higher. We are very close to all-time highs, closing at, well, overnight actually, sorry, at 25,369. And our all-time highs would be sitting around 25,394. So we are within striking distance, and if momentum persists, might get there as early as tomorrow. Now, if we're looking to the sectors that are really driving that recovery, I'm going to start here on SMH. I'm not going to cover healthcare. That was another strong performer, which we mentioned in the intro, but we're not in any trades there. So we'll just look at SMH. Obviously, the Nasdaq is our proxy for tech. This is our proxy, or the ETF, for the broader semiconductor space. And you can see this actually had the strongest recovery, breaking into fresh all-time highs today before closing slightly down, but still giving us our highest ever daily candle close. And if we look at just one specific name in the semiconductor space, that would be NVIDIA, which we've been tracking for that breakout, or that sustained breakout above $185, which we did, and then reverted back below. And we are just flirting with that again. So I would love to see NVIDIA firmly break above this range, even though we had that breakout of resistance and fell back underneath. Broadly speaking, we are still making higher highs and higher lows. So we just need to see this momentum continue. And as NVIDIA goes, so goes the rest of the market, at least in our current environment. Not much to say on the dollar outside of that higher low that we called on Friday getting confirmed with a move away today. Now we want to see if the dollar can break through that 99.5 resistance to continue on this up track. If we do switch over to gold, despite gold having a massive day of selling on Friday, it recovered nicely today. And let's see, did we make fresh all-time highs? Oh, just barely. It looks like we eked out by a couple dollars some new highs on gold, and now in the overnight action are seeing a pullback. Again, like I mentioned on Friday, gold has been overextended. It would be healthy to see some chop and consolidation for the next little bit here on gold for it to cool off. Okay, I want to revisit some of the trades we covered on Friday that we have been covering on Patreon. I don't know if you guys caught it, but I posted our weekly call, not this Monday today, but last Monday, just because the markets had crashed. And I wanted everyone to get a sense for what we were keeping an eye on. But if you didn't get a chance to check that out, look at my X. There is a link there. But CLF was one of the names. And this had printed an inverse head and shoulders, which we can see right here. And I did not think this would break out quite this quickly to the initial price target. But after a pullback on Friday, we got an over 25% jump today with this up higher in after hours. So on its way nicely to that $19 price target from that initial $12.50 range. I'm just going to start with all these Patreon trades. Another one is MC, or LVMH, Louis Vuitton Moet Hennessy. And we were tracking this as we came back down into the breakout zone. And there were positive news on this today with a massive gap up. And this jumped over 16% already. And in terms of overhead resistance, we do have this longer standing downtrend. The luxury space has been in a bear market for quite some time. Actually, we measured out this double top right here months ago for the eventual price target. We didn't quite get there. We reversed before 400, reversed at 435, but got pretty darn close. And now this downtrending resistance line would be our next target at 658. If I had to stack up the probabilities, I would say since we're coming into it for a third touch point, this is a good trade right here, but I would anticipate most likely a bit of resistance, then a cool off where you might get another entry before breaking out after that. So keep your eye on this one. Even if you miss that last little jump, there could be another opportunity in it. Okay, next on the list, we'll look at AXON, and this one is just starting to bounce. And if you haven't gotten in it, there might still be another opportunity. We're just into the Confluence Model Center cloud. We are underneath the 50% fib level. Normally I have that as orange, but my colors got flipped around a little bit. But we have this underside trend line. If this still chops around a little bit, we're under overhead resistance. I really think this is going to find strong support at that underside trend line, which would be our third touch point of this white line, which has the highest probability chance of a bounce. And we are just in a nice falling wedge pattern too, which traditionally breaks bullish. So keep your eyes on this one. Look for good entries, but it seems like this is gearing up for some kind of reversal. I'm just going to keep going here. And REGN, this is a pharmaceutical play, so be careful with pharmaceutical plays. But I wanted to cover this one just because the chart looks like a fantastic recovery play. If you look at this, we've been in a massive downtrend since the all-time highs in August of 24. And if we just measure that out, how far down we have come, that is a drawdown of a cool bottom to top 60%. And we've been forming this nice basing structure. And right now we just need to try to get above the 200-day moving average. In terms of risk to reward, you have a lot of potential upside, and you have a clear invalidation at these lows right here, which are coming in at about $541 would be your stop. And you can just be watching this one. It might not break out tomorrow, but if it comes back to those lows that it has been bouncing off at that $540, that's a great risk to reward entry where you can put your stop just below and see as if this is coiling, if it can mount the strength to get back above the 200-day moving average. And earnings on the 28th of October might be a catalyst for that. And last one here, AQMS. And now this is a riskier play in the metals space. And they signed some new partnerships with other players in the industry. They got their Nasdaq recertification. They have contracts for new deep sea mineral exploration. And I got in a little bit today. This is a little bit risky again, but we've been forming a very clear base right here at the 200-day moving average. And the price is being supported at roughly, let's say $12 if we look at these lows. So as we were coming into this low today in the 200-day moving average, I took a nibble on a position. My stop would be just below at $10.73. And if we can bounce from here, it could have something in it. After all those positive news, it really jumped from $6 all the way to this blow off peak at 40. And now we've been in this tightening range. You could argue that it is bearish in terms of this forming a descending triangle, which normally breaks to the downside. So this is going to resolve in the next couple of days. But I thought it was worth a swing because I've seen a lot of these setups recently break to the upside, the way statistically you think they would not break, especially with the tailwinds in the metal space. I thought it was at least worth a little swing. Okay, let's get back into the normal routine. Bitcoin and Solana are coming up in a minute, but I just want to look at HSI and some of the Chinese names. So HSI, obviously, on the China-US tariff tensions, got beat up on that. It has made a very nice recovery, almost reclaiming 50% of the losses. And if we look at the individual names, Baba is one of the standout performers, which I have to admit I missed the entry on. I was looking for just a little bit further correction. You can see where my alerts have been set here. I missed this one here. But we recovered all the way to the 786 today. Very strong reversal day. If it comes back down, I'm going to be looking for an entry on BABA. Okay, next one on the list is BIDU, which also had a nice run up and a retest of the 50%. And I was tempted to take a position on this today, but I decided to hold off for the simple reason that we hit the price target. So we had a falling wedge. You can see right here, you could argue that we have a bigger falling wedge, but the price target would be measured the same. But from this first falling wedge, we really hit that price target and then had a blow off extension. So I'm just going to go into a mode of watching this. It doesn't mean the price can't go higher, but the most probable thing right now is going to be a bit of tightening up or consolidation before figuring out what the next move is. And if I let this price action play out, I might not get the best entry, but I can get some more signals based on what the recovery is doing, and I can see if it looks like more of a near-term extension or if we're going to correct a little bit before the next move. And last one on the Chinese names would be JD, which I did get into a position on last week, and I had a limit order set right down here at the Confluence model lower band at $31.50. And thankfully I had a limit order set because this dipped down really quickly and bounced away. Also seeing a strong recovery today. So this one I was getting really close to trying to nail the bottom here locally. And it seems like we're printing our first higher low and that entry, at least for now, is looking pretty good. We're getting the Confluence model band squeezing. We have some overhead resistance to watch out for from, massive years-long downtrends. We have underside support. So I'm feeling okay on this one, and this one is also going to resolve and make a decision by January in the next couple of months of, are we breaking up? Are we breaking down? Liquidity has me on the side of breaking up. Okay, if we're looking to Bitcoin, I'm just going to keep this focused on the short time frames. And we did have resistance over the weekend under the 200-day moving average. We broke above that, back tested this breakout zone for support. Now we're back in the Confluence model center cloud. Could go down to as low as 109,000 and back test that break into the center cloud as support. But even though this is very near term, the recovery is looking good so far. I like where we're at in the center cloud. And we really just have this overhead resistance to tackle from our all-time highs, coming in, depending on when we intersect that, somewhere around 111 to 112K. So getting above this downtrending resistance is going to be what we want to see for Bitcoin to be mounting a potential recovery. And if we're looking to underside support and just compressing all this price action, again, I really have to compress all this price action because the line has been removed. And if we go to the yen carry trade low here on August of 2024, and we draw our underside support again, just so everybody can see where that's coming in. That right now, depending on when that would be intersected, would be at around 95,000, where there's a lot of confluence around there. But as I said on Friday, I would rather not see that happen because Solana and many other names are at areas where they could be breaking down in a more meaningful way. Okay, shifting over to Solana, and I'm on still a messy chart, but a slightly less messy chart. And if we're looking at our fib levels just from our all-time high in January to our low in April, we just tested the 50% level at 195,000 from the underside today. So getting above that 195 level and then 205 would be my next major hurdles for Solana to cross over. But in terms of forming almost a bit of a double bottom, a little too soon to call, support at the 200-day moving average at the Confluence model center cloud, support at the trend line. We're in this massive symmetrical triangle pattern. Solana bouncing from here is what I would love to see. Just taking the fib levels off so we can all see this a little bit better together. And we're just poking above this trend line. I think we might have just diverted back underneath it, but let's go into the small time frames to see what's going on there. Okay, so we are flirting with a breakout. And I keep saying flirting with this support zone, this resistance zone. I can't think of a better descriptor. If you guys have any suggestions for a better word than flirting with, let me know in the comments because I need to expand my vocabulary. Anyway, we just had one little wick above on Wednesday of last week, and then we broke above more meaningfully earlier today. Now we're just underneath, but we're holding the Confluence Model center band for now. So seeing that hold and a continued bounce would be a great sign, but really getting above that 195 zone and then the 205 zone would put us on a much stronger path to recovery. If we're looking to Ethereum, a very similar chart to Solana right now. Bitcoin, Solana, Ethereum have been moving in lockstep, but slightly higher lows. We are back into the Confluence Model center band, hopefully back testing that for support before forming another higher low and continuing the recovery. If we're looking at zones to get above in the near term, I would say this trend line right here at 4,100. 4,100 has really been the key level, kind of this dividing zone between support and resistance that we need to get above. We didn't quite make it up there today. We got to 4,091, but it seems like getting above that zone, I mean, 4,091, that's still close enough for rejection in my book. But bouncing and getting above that would put us in a much stronger stance. And then above that, almost every $100 for Ethereum, we're looking to resistance on the upside. Okay, MicroStrategy, I'm sticking to the small time frames. We still have that support underneath at about $245 to $250. A little bit of a bounce between Friday and today. We still haven't made higher highs than that 315. So this really, I'm just watching Bitcoin, honestly. If Bitcoin keeps recovering, I'm going to feel good about MicroStrategy. If Bitcoin falls to that high 90 range, we are most likely going to test this trend line for support. And then if you want to take a swing at MicroStrategy, it has been out of favor, but that would be a higher confidence entry for me for a shorter term trade. All right, Tesla, we have still been range bound. We are playing around with breaking out from the upper end of the range. If we get above 350 tomorrow, I think we're really going to start picking up momentum. But there is a world in which where these Confluence Model bands squeeze for, another couple of days, and we could just chop around in here before deciding which way we want to go. That said, we do have earnings coming up on Wednesday. So my money would be on somewhere around here, volatility picking up one way or the other, and we'll finally make a decision of, are we going to break down and get back down to about 370 to 380, or are we going to move up and test 500, potentially 530 for some of these extension price targets. Often when earnings hit, there can be volatility in both directions. It is a risky time to trade, but often with earnings, the initial reaction is the incorrect one. So if you see a big spike up, watch out, because that can just as quickly reverse in the other direction. Okay, there are so many charts to watch right now, so I'm just trying to cover the ones that are most important for near-term trades. And HIMS looks interesting. Now, there are on the smaller time frames, the 1 hour, all the signals of this being a bottom and a potential reversal. We are finding really strong support here at $50, which is the point of control in terms of the VRVP and the most historical buy and sell volume. If we do break down just a little bit below this, I'm looking to about $45 to $46 for support because of the 200-day moving average, also because of the bottom of this previous range, these previous tops. This would really be the strongest zone to anticipate a bounce if the price moves down a little bit more, and if that happens over the next couple of weeks. I would be keen to take a swing trade there. There's been lots of volatility in HIMS, and it's a great one to trade on the shorter time frames with options or even just with spot, just because of the percentage in the moves. And each of these moves is playing out over like 4 to 5 trading days. This last one here was really a 23% move to the downside over 2 trading days. So lots of action to take advantage of on HIMS. Moving on briefly to Unity software, which I've been building a position in. I had another little limit order fill today at this dotted line at about $33.50. And I'm hoping I can get more of a position to fill around 30 to 31. I have a few more limit orders in that area. But if we are looking on the 4 hour, we have now taken our 3 swings in the lower band, which normally correspond to a recovery. If we're looking at mean reversion and RSI, that's still forming that bullish divergence. If we do look at the daily would suggest, just based on the mean reversion dot and RSI, that we could potentially correct a little bit more. But the 4 hour is pointing to a turnaround. So we'll have to wait and see. But bouncing here does make a lot of sense. Just from these previous highs, I was just hoping we would get more into this $30 to $31 range. But if it reverses from here, I'm fine with that too. And I would just add a bit to my position to get to the full size I want to be in on that recovery. Okay, last one to cover on Deckers, just because we're moving into earnings and we have mean reversion dots on the daily. Daily RSI is to the bottom end of the range again. Earnings is coming up, so this is pointing, based off of all these bounces, our third time retest of this $94 level where we've been scaling into, that this bounce should continue and can hopefully give us our larger time frame correction to get back up, maybe not to $224 in the near term, but we would be looking for recovery of at least 50% of that massive drop that we have seen this year on Deckers, which would put us right at, let's say, $160. So not a bad move if it can do that. And I'm looking to earnings to be a catalyst after the previous earnings being positive. All right, you know what? I know I said Deckers was the last chart, but then I remembered so many of you are in UPXI or have been asking about it. And, you know, if Solana ETFs finally launch, this could finally see some tailwinds. But we've been in this massive consolidation range. It looks like we broke to the downside, but we're trying to get back into that range today. The 4 hour mean reversion is diverted to the downside. 4 hour RSI hit the bottom of the range. So a lot of signals are pointing to recovery here. And we will just have to, I suppose, let Solana be the leader for this one, like Bitcoin is the leader for MicroStrategy. So that is it for the charts. I went a little bit quickly today, but there are so many charts to pay attention to. I normally don't do this and I just keep it for the Patreon, but I do have a watch list for TradingView that I'm going to share a link for down below. So if you're interested in seeing everything in my watch list that I keep tabs on and scrub through daily, you can access that there, and I update it daily and weekly. You'll just have to refresh it via that link. Now, this week, in terms of things I'm watching, it's really just the indices to see if we can make those fresh highs. And I'm also watching crypto to see if it can catch up, because we are definitely at a critical inflection point for that asset class. Also, assuming the indices print those fresh highs, it is a week of shopping for me. And on any down days we might see, I am going to make sure I get into all of my desired positions, because that move to fresh all-time highs indicates that we are moving into a positive end of year in November and potentially through December. Now, if you want to keep up with the latest, you can of course follow me on X for regular updates there, or if you want all the real-time trade alerts, as well as many other macro updates and things we're watching in markets, you can also hop into the Patreon. We have a 7-day free trial for any tier, so you can see exactly what I'm posting there. Link is down below. And I will see all of you guys on Friday for the weekly wrap-up. Bye for now.